Welcome back, guys. Today we're going to analyze International Business Machines, or IBM. Over the past 5 years, they're only up 25%. They completely underperformed the S&P 500, even when you account for the dividend, which is 4%. And they are a $150 billion company. The price to earnings ratio of 19 is not too bad. Hopefully, they have some growth to go along with that. Let's take a look at their financials here. In terms of their statements, it looks like they divested a business in 2019 because their revenue dropped like crazy. Could have also been the Rona, but then after that, it's been growing pretty steady at like 2%. Well, 2% last year. I would probably expect 2% moving forward, probably just keeping up with inflation based on their past results here. In terms of their gross profit has really dramatically improved ever since 2019, it looks like. And so it has translated pretty well into their operating income as well. Like their margins have improved, even though they decreased in revenue. Although I would expect that their margins would probably be pretty consistent moving forward. They have a lot of debt, so they've got a lot of interest expense here, and they've had a couple unusual expenses, probably some write-downs on assets. Otherwise, the last year's net margin seems very consistent. They've also been diluting shareholders a little bit, probably through stock-based compensation because you don't see it on their cash flow statement. In terms of their balance sheet, they do have a lot of debt, 46 billion in debt. That's kind of a lot. When you're making like what 8 billion a year. Yeah, you're making like 8 billion a year. You've got 46 billion in debt. It's not good to see. In terms of cash flow, what are they doing with their cash? Well, they're not buying back any stock. They're not issuing stock. So that means that the diluting of shareholders is from stock-based compensation, which really makes their cash flow look really amazing. But their earnings are way lower. They have taken out some debt in the last year, probably. I'm not quite sure why. They should really be paying down that debt. And they've been paying dividends, and it looks like the dividends have been increasing every year. So this is like a classic dividend growth stock, although I'm not too excited about it. We could take a look at their gross margin and see what it is, or their net margin. Yeah, it was 12% last year. I kind of expect 12% moving forward as long as they don't have too many write-downs in their assets. Let's take a look at this is what I wanted to look at. What are their segments of their business? Well, software is actually the largest segment, and they have an 80% gross margin on that. So that's really good. Consulting is after that, and the gross margin is way lower, probably, yeah, because you have to pay the workers most of what they consulted for. And yeah, the consulting business has increased, the software business has increased in revenue at least. And the infrastructure business has actually declined in revenue. And then financing has increased and other. So in total, their gross profit increased a little bit in terms of, what is this? Maybe it's non-GAAP or GAAP. Yeah, non-GAAP operating gross profit of 34. Well, that is an increase. In terms of their software revenue, where are they getting it? Well, they've got this hybrid platform and solutions, which is most of it. And that's Red Hat, automation, data, and AI and security. Although they don't break these into segments, which I really hate. I really hate when companies hide information like this. Like they have the growth rate of each of these. Like, oh, look at that. Red Hat grew by 9%. Well, okay, put the number here then. Like, why can't we see what the number is here? Like, you can easily grow 9% if Red Hat was only, what, like 1 billion of this. So that really pisses me off. Super annoying how companies do that. They always paint a rosy picture like they're trying to sell you on their business, which is really annoying because that's not really the point of a business. The point is to give investors the information that they need to make an informed decision. Seriously. Taking a look at the Yahoo Finance stuff, we've got their estimates here. Looks like they estimate that IBM is going to grow by 4.5% next year. I actually don't think that they're going to. Well, they could hit that. 4.5% is not that high anyway, and their earnings are expected to improve as well. In terms of their stats, their let's take out their check their short percentage. Yeah, their short percentage is 2.5%, which is actually really high for a consistent business like this. Yeah, that is kind of a red flag to it. 2.5%. I mean, it's still lower than 5, but yeah, but not really good for such a large and legacy business. Let's take a look at the model that I've got for these guys. So I put the EPS estimate, revenue estimate here. Buybacks is 0 because they haven't done any. Net debt of 46 billion. Discount rate to 10% because I want a 10% return. Exit multiple of 18. They're currently trading at 20. I think 18 is fair for these guys. Probably even lower would be better just because of the debt load and the low growth. In terms of growth, I have 2% just basically keeping up with inflation. And in this case, they are overpriced even without accounting for debt. When you account for debt, then they're looking at like $130 a share. I'd probably put them at. And in terms of revenue, I have their revenue growing by 2% and their profit margin at 12%. That's what they did last year. I think that can be sustainable moving forward. And if they do these numbers, then we're looking at a fair share price of $126 and a fair share price after debts of 76. I'd probably put them at like $110 a share. So yeah, definitely not buying this business. I really think it will underperform the S&P 500 moving forward, and I'd rather buy something better. So that's my 2 cents. Let me know what you guys think in the comments and hit that like button. I'll see you in the next video.